do a videotape. So as I'm taping this here, don't ask questions until I'm done. But here we're going to talk about, once again, people, this is the S&P 500. And basically, we have this long-term diagonal trend line on this weekly chart. One of the things that we have emphasized time and time again is how do you go from a bear market, as we were selling short in '08, but how do you go from a bear to a bull trend? What are the patterns, characteristics, and what is the nature between the buyer and the seller, and where does the turning point start to take place? Well, it's very simple. We have had a very nasty, we were short the S&P at 1150, and everyone watched us buy the 1150 puts. Some people are well over $200,000 on these put options because the contracts were very cheap at that time. That's where the institutions came off to play. So basically, with this double week reversal pattern, the thing about it is the blue line is a 10-week moving average. I am sorry to have to inform all of our senior pro traders and the rest of the world is that when that starts to roll over and you're below the red line is the 20-week moving average, there is key levels that intraday institutional traders and hedge fund managers who are out here in the market, a lot of them that we train, are going to whack. And what do I mean by saying the word whack? Anytime that we come up, they are going to have limit orders out ahead of the market, pre-programmed and ready to knock that down at that resistance level. It's going to take a lot more buyers or bulls in the market to overcome the new trend that has started to develop here. And we teach you here about how to work with weekly moving averages. They're very important. If a weekly moving average is starting to descend means turn over. I am sorry, whether it's an equity, whether it's this particular index or anything for that matter, you are to be an aggressive put buyer, an aggressive short seller. So the S&P is going to have resistance, and what happens this is the trend reversal that we did. We are heavily short that. Now, for every beginning market top or bottom within the S&P, whether it was the bottom that we were buying and going long, we shorted it all the way down there because we did, and people were here, they watched me do it. Now, another thing here is that people, basically what senior traders and traders are going to be doing is that there's a counter trend to a reversal trend. Just like at the bottom, this one started abruptly. It went into the SMF bull trend when it closed 4 weeks above it. The 10-week had been falling down. You can't go into a bull trend. You got to close 4 weeks above it. It has to be flattened out. Vice versa here, folks, is that the rollover, I've only got 1-2 weeks. If the S&P does not get back above that 10-week moving average, and if it closes below it 4 weeks in a row, that is an official bear trend, period. That means that the trend from the bull cycle is entering a new cycle. When tops get put in or bottoms get put in, there are 4 stages to a market top. There are 4 stages to a market bottom. There are 4 stages to an equity bottom or an equity top. And we have a mathematical formula that develops the strength of that trend or that momentum. So basically, you will always get a counter trend to a reversal trend. Things don't go straight down. So I'm short the S&P. I can't get my price back because I'm making so much money already. Let me pause the tape and I'll show you the put option. All right, so here are the S&P 1150 put options relative to the S&P 500 chart. We started buying these between $21 and $22. 3 weeks ago was when we started getting in because I called a market top, and I told people when I was in Laguna Beach doing some training over there and enjoying the coast there, is I told people back in November, December, the minute that S&P hit 1150, the institutional people were going to pack up and leave town, and they sure did. And, you know, it took a while to get up there, but once it got right there, we already knew where the institutional people were going to get off the S&P. And 3 weeks, we've gone straight up here. If you had 10 contracts here with me, and you were, you know, I guided you in and I got you in, you'd be up $50,000 in 3 weeks. Because you would be, and we are. I've got guys that have got 50 of these contracts. I've got some guys that got 100 of these. I've got some guys that only got 10. I've got some guys that got 30. But look at the coin. That's the 3-week breakout of the S&P 1150 put. There are also some other contracts that we have, and these are shorts. So the 1110 was bought. First, the 1150 was bought. Then after that trade was locked in, we went right over here, people, and this is the 1110 put. And basically, they were deflated. And the market was putting in a top on the indexes. They used to be inflated. This is called an inflated put contract last year. We bought down here, people. Sorry to tell you, this is wholesale money. If I'm buying 10 contracts, and people that were buying them up here, or you bought 10 contracts at 30, and Mario's buying 10 contracts at $11, and I'm buying 30 contracts, that's about, do the math, that's over $33,000 wholesale in the entry. This is a business, pal. It's about wholesale, wholesale, wholesale versus retail. Inflated, deflated, back up with the market reversal. So we own the 1110. We're going to be monitoring these things very carefully because I'm going to go back to the S&P 500 chart. Here is the market reversal right here on the weekly. 3 weeks down, 3 weeks up in the put. Now, we will always have certain support levels on the S&P, and there will be days that the S&P will bounce. But right now, on the technical thing, you know, we have a mathematical formula that I'll show you today that tells us how to trade it. But here's the thing. We are below the 20-week moving average. Here's what happened when you undercut the 10. Now you're below there. So basically, every morning that we've had every gap, it's been a sell gap. So you gap up in the futures, big floor traders, people like me, hedge fund traders, they come in and they start shorting the other side of everyone else. And somewhere within the structure is that the buyer is going to have to be 3-1 to the short seller in order to find stabilization. If we have or see that, what we will do on the S&P is we will go right over here to the call, which is a 1080 call. We'll go up and out of the money, the $1,100 call. Now, by me showing you the $1,100 call, it would be a way to trade this against the put option on the S&P 500. We do it very well because we are a market maker. That's what we do. And so I'm going to pause the tape. This right up here is a 1080 call that 3 weeks ago was $70 a contract. So people who were long these calls rode them down miserably because they don't know miserably how to do it miserably right. So for every part of misery, there is also a proactive trade against the overall misery in the market. And basically, with this deflated, this means that the call side of the S&P, this is the 1080 that we'll be looking at buying, and the 1100. It's basically in the deflated area, and the 11